Start with a simple question. How do companies fund their growth? Whether it's a small startup in a garage or a massive multinational, every business faces this challenge. The answer lies in what's called the capital structure. This is the unique blend of long-term financing a company uses to fuel its operations and expansion. Think of it as the architectural blueprint for a company's financial foundation. In the next few minutes, we'll break down the core ingredients, the math behind the mix, and why it matters for every business. The heart of every capital structure are two main ingredients: debt and equity. Debt capital is borrowed money, think bank loans, bonds, and debentures. It comes with a legal obligation to pay back plus interest no matter how well the company is doing. Equity capital, on the other hand, is raised by selling ownership shares or reinvesting profits. There's no requirement to repay equity, but it does mean sharing future profits and giving up some control. Understanding this balance is crucial for any business leader. Picture a split screen. On one side, a modern skyscraper blueprint, on the other, a classic vault room. This image captures the dual nature of capital structure: forward-looking growth and solid financial security. The blueprint represents the company's vision and expansion plans, while the vault symbolizes the resources and obligations that make it possible. Together, they show how debt and equity work hand in hand to support a company's ambition. Let's take a closer look at debt capital. When a company borrows money, it agrees to fixed payments, interest, and principal, regardless of how much profit it makes. This can be a double-edged sword. On one hand, debt can boost growth by providing immediate funds. On the other, it increases financial risk, since those payments must be made even in tough times. Companies must carefully manage how much debt they take on to avoid financial distress. Now let's explore equity capital. When a company issues shares or reinvests profits, it's raising money without the obligation to repay. Investors become part owners, sharing in the company's success and sometimes its struggles. The upside: no fixed payments. The downside: existing owners give up some control and must share future profits. Equity is often seen as a safer, more flexible way to fund growth, but it comes at the cost of dilution. Measure how much debt versus equity a company uses. Analysts look at the debt-to-equity ratio. This simple formula divides total liabilities by shareholders' equity. A high ratio means the company relies heavily on debt, which can amplify both gains and losses. A low ratio suggests a more conservative approach, with less risk but potentially slower growth. This metric is a key indicator of a company's financial strategy and risk profile. Leverage refers to how much a company uses borrowed money to amplify its results. High leverage can lead to higher returns when things go well, but it also increases the risk of losses if profits fall. Companies must strike a balance. Too much leverage can lead to financial trouble, while too little might mean missed opportunities. Understanding leverage is essential for making smart capital structure decisions. Another crucial metric is the weighted average cost of capital, or WACC. This figure represents the average rate a company pays to finance its assets, blending the costs of debt and equity. A lower WACC means cheaper financing and more value for shareholders. Companies constantly seek to optimize their capital structure to minimize WACC and maximize growth. It's a balancing act between risk, cost, and opportunity. Imagine a sleek financial dashboard with meters and formulas lighting up in neon blue. This is how CFOs and analysts track the health of a company's capital structure. They monitor ratios like debt to equity and WACC to make informed decisions. These tools help leaders understand the trade-offs between risk and reward and guide the company towards sustainable growth. Well-designed capital structure isn't just about numbers, it's about strategy. The right mix of debt and equity can lower costs, reduce risk, and unlock new opportunities. On the flip side, a poor structure can lead to financial distress or missed chances for expansion. That's why companies regularly review and adjust their capital structure as markets and business needs change. Choosing between debt and equity isn't always straightforward. Debt is cheaper but riskier, while equity is safer but more expensive. The right choice depends on the company's goals, market conditions, and appetite for risk. Smart leaders weigh these trade-offs carefully, aiming for a structure that supports both stability and growth. Investors pay close attention to a company's capital structure. A high level of debt might signal higher returns but also greater risk. A conservative structure may attract risk-averse investors. Ultimately, the mix of debt and equity influences the company's stock price, credit rating, and ability to raise new funds. It's a critical factor in investor decision-making. Let's look at a real-world example. Imagine a tech startup that starts with mostly equity from founders and early investors. As it grows, it might take on debt to scale quickly. Later, it could issue more shares or refinance its loans. Each stage requires a different capital structure tailored to the company's needs and market conditions. This flexibility is vital for long-term success. Even the best companies can stumble if they mismanage their capital structure. Too much debt can lead to bankruptcy, while too little can limit growth. Market changes, rising interest rates, or unexpected losses can all impact the ideal mix. That's why ongoing analysis and adjustment are so important for financial health. Wrap up: capital structure is the foundation of every company's financial strategy. It's about finding the right balance between debt and equity to fund growth, manage risk, and maximize value. By understanding the core concepts and key metrics, business leaders and investors can make smarter decisions. Remember, the architecture of capital structure is always evolving. Staying informed is the key to long-term success.